Today, the MCX share price jumped over 5%, a move that has traders and analysts rechecking orders and charts. The rally matters because MCX is the backbone of Indian commodity and derivatives trading, touching metals, energy, agri-markets, and even currency hedges. When a single exchange stock moves decisively, it reflects shifts in liquidity, regulatory expectations, and the momentum of the broader market. Investors watch these doors for signals about futures volumes, collateral requirements, and market structure. In a world fixated on global inflation and commodity volatility, a 5% swing signals potential shifts in risk appetite and capital flows. Station by station, the story is straightforward. The stock rose because buyers outpaced sellers after a surge in trading interest and improved liquidity across the multi-commodity exchange. MCX is India's largest exchange for commodities and derivatives, handling copper, crude oil, gold, silver, and agri-contracts. A higher price usually follows more demand than supply, plus optimism about regulatory reforms, better risk controls, and expanded product suites like new futures or options. In plain terms, investors are paying a premium for confidence in clearing systems, settlement efficiency, and the ability to manage volatile price swings without disruption across global markets. Background: the rise of MCX is not a one-day event. It sits in a long arc of Indian commodity markets maturing alongside reformist policies. The exchange began operations in 2003, competing with old platforms and state-run entities, and gradually expanded products from gold and silver to copper, crude oil, and agricultural futures. Regulatory changes in 2008 and 2010 opened new hedging tools, attracting farmers, traders, and banks seeking transparent price discovery and safer clearinghouses. Over the years, MCX's technology upgrades, risk management, and connectivity with brokers created faster settlements, deeper liquidity, and a culture of standardized contracts that helped bring far more participants into the market. Current market impact. Traders are watching the move as a gauge of risk appetite and hedging demand. A jump of this magnitude often accompanies rising volumes on MCX, suggesting institutions and hedge funds are rotating into commodity baskets. The reaction also ripples into related equities, derivatives, and payment flows through clearinghouses. If MCX strengthens its price discovery and settlement reliability, brokers attract more clients, which in turn boosts intraday liquidity. On the macro front, higher MCX volumes can accompany shifts in currency hedges and import costs, shaping the pricing of metals and energy across domestic and regional markets globally today. Who is affected? The ripple effects touch producers who hedge, traders who price risk, and investors who own related assets. For listed companies, MCX moves influence funding costs, inventory valuations, and hedging strategies, especially in metals, energy, and agri-linked businesses. Banks and brokers gain from higher trading volumes and clearing fees, while custodians and data providers scale up infrastructure to handle more clients. Retail investors gain indirect exposure through funds and ETFs that track commodity indices. Policymakers and regulators watch liquidity and settlement metrics to ensure market integrity, while miners and refineries monitor futures price signals that guide price plans and long-term planning. Geopolitical and macro factors. The MCX move sits inside a broader global backdrop where supply chains tighten, inflation remains stubborn, and central banks recalibrate policy. A softer dollar can lift foreign investment into emerging markets, while India's domestic growth story supports commodity demand. Trade tensions, sanctions, or droughts alter price discovery for grains and energy, amplifying volatility on exchanges like MCX. Investors weigh monetary tightening, budgetary impulses, and the pace of infrastructure spending against commodity cycles. In short, MCX rises not in isolation, but as a reflection of interconnected cycles spanning agriculture, metals, energy, and financial markets across global markets. What smart money is doing? Institutions and savvy retailers are rebalancing portfolios toward defensive assets and inflation hedges while watching MCX's liquidity metrics. Some hedge funds may trim riskier positions, rotate into high-conviction commodity baskets, or buy protection via options to cap downside. Banks may expand lending to producers linked to rising prices, while brokers upgrade platforms to handle higher volumes and faster settlements. Retail investors, influenced by robo-advisors and financial education, show growing interest in commodity index funds and exchange-traded notes that mimic MCX assets. In every case, information, speed, and cost matter more than ever. The bear case and risks. The rally could fade if liquidity tightens, volatility spikes, or a regulatory crackdown alters margins. An unexpected policy shift could slow domestic growth or raise hedging costs, reducing participation. If MCX faces technical outages, clearinghouse defaults, or cyber threats, confidence collapses quickly and price discovery falters. The highest risk is over-extrapolation. Investors chasing a single narrative may overlook collateral requirements and margin calls that squeeze positions at the worst moments. Also, commodity price reversals, supply shocks, or unfavorable weather could reverse demand and deflate the exchange's valuation. Diversification and disciplined risk controls remain essential in any such volatile climate. How retail investors can respond? Start with educations and clear risk limits. Don't chase a single stock move. Instead, build a diversified basket that mirrors macro themes like inflation hedges and global growth cycles. Use stop losses and position sizing to weather volatility, and consider low-cost index products or sector funds that track commodity exposures rather than individual bets. Monitor liquidity indicators, margin requirements, and clearing fees to avoid surprises. If you're curious, practice with a paper trading account first, then gradually allocate only a small portion of your portfolio to exposed commodities. Consistency beats speculation over the long run. Outlook and call to action. The near-term resonance of MCX moves depends on how global risk, inflation, and policy converge in the months ahead. If volumes hold and clearing mechanisms prove resilient, the stock can sustain momentum as hedge funds and sophisticated traders trust the exchange's infrastructure. A favorable price discovery environment supports producers, consumers, and independent traders, while continued reforms or product expansions could widen participation and accelerate liquidity. Yet risk remains from sudden policy shifts or external shocks, so stay disciplined and informed. If you found this valuable, subscribe to the Commodity Brief for weekly insights on alternative assets and commodities.